Wherever you are on your road to retirement, we're here to help you stay on course. Welcome to Mason Street Retirement Insights, the show dedicated to helping you plan your financial future.
What is your biggest concern? People are very focused on the amount of money that they have saved, but it's really about the income that we generate. Income is what's going to drive lifestyle. And so the income strategies that we utilize are what's key.
And now, here's your host, Sean Mason.
And my name is Casey. I'm alongside Sean every week here on the show. And Sean's here to help us take a look at the bigger picture around our retirement and really answer those big questions that we know that you have. So we're glad you're here with us. And Sean, I'm glad you're here. Great to see you. How are we doing this weekend?
I'm really glad to be here too, Casey. It's good to see you. I don't know what's going on this weekend, but I'll tell you last weekend, I went to Yosemite, and I got to remind everybody here, you can't believe how many people I run into and meet in Fresno that have never been to Yosemite. Mm-hmm. And I'm telling you, I go up there 4 or 5 times a year, and every time I turn that corner, you all know when you come out of the tunnel and you get that visual, I forget how extraordinary it is. And so just want to remind everybody that we've got that right in our backyard. So head up there. Yeah, it's
I'm one of those people that you're talking to. I've never made it out there, but I was just reading that rattlesnake bites are up this year. Did you see that?
I did.
So I'm a little worried about the snakes.
Okay. Well, we've got them all over the place, so I don't know how you're going to get away from it.
All right. Well, I'm just going to have to go with the guru here, the Yosemite guru. You're going to have to take me, show me all the spots because I need to see it. I know it's beautiful.
Let's go. I'm all in, and let's not go past June. I mean, it's great after June, but during June, waterfalls are on hit.
All right. Well, we've got some great retirement conversation I want to get to first today before we go outside and enjoy the beautiful springtime. But I'm excited to get your thoughts, Sean. So as you're listening today, if any part of our conversation gets you thinking, am I as prepared for retirement as I need to be? That's exactly why Sean is here. And the even better news is that he has set aside a few spots on his calendar that are exclusive to our radio listeners for his introductory retirement planning assessment. And Sean is going to do this for you completely complimentary. So we want you to write this number down. Keep it handy, 559-847-0039. When you give us a call during the show today, you can schedule some time for your very own introductory retirement planning assessment. This is a conversation directly with Sean, and this can be a phone call, this can be a Zoom, this can be in person. Sean's local, he's right here in Fresno, so it's whatever you're comfortable with, but this is a one-on-one conversation all about you, all about your specific situation. And Sean, I want you to talk to us a little bit more about your process and what people can expect if they pick up the phone and they schedule some time to meet with you today.
Yeah, it's a great opportunity to come in and really get some insight. People come in and they say, Sean, I don't know what I don't know. And I'll tell you, we cannot be having that in retirement. And so, if you are feeling like you're not sure if you've got it all together, not really connecting the dots, you really got to come in and have a discussion. And you can't believe how much better off you feel when you see that everything is going to work out and that you get clarity and certainty and that lifestyle is going to be the way that you expected it.
559-847-0039 is that phone number for you. Again, there is no cost. There is no obligation. This is just a discovery conversation. Very low pressure, but our space is limited. So again, that number to do it, 559-847-0039. I would go ahead and act now. Claim your spot, or you can also learn more when you find us online at masonstreetretirementinsights.com. All right, Sean, let's jump right into it because I want to talk today about one of those things that people hear about all the time, but they don't always do. And that's a tool that we call rebalancing. But what exactly does it mean for your retirement portfolio? Well, we've got Morningstar's Amy Arnott talking about this. Let's take a listen.
Rebalancing usually will involve selling assets that have gone up because they would be over your target levels and using those proceeds to buy into asset classes that have gone down. And why that can be difficult is sometimes if things are going up, people are reluctant to sell. And in fact, you could miss out on some gains if you sell for rebalancing purposes. So the purpose of rebalancing isn't necessarily to improve your returns, but really to control the risk level of your portfolio so that it doesn't drift too far away from your target levels.
But it's estimated that about 30% of those nearing retirement, that's in that 55 to 64 age range, they never rebalance their 401ks and their IRAs. So I'm wondering, Sean, what problems can happen? Can you talk to us about your thoughts around rebalancing?
Yeah, Casey, it's a really good topic that you bring up because it just doesn't get the attention that it deserves. And it's a really important piece of the investment process. As Amy was pointing out, you really got to make sure that you are staying within the confines of that target allocation. And as she pointed out again, it's really about the risk. It's not necessarily about the rate of return. So rebalancing happens on multiple levels. You can have a mutual fund manager. You can have an exchange-traded fund manager, and they have a group of stocks or a group of bonds or a combination of, and they want to make sure that each one of those holdings has the right weight. And so sometimes they have one stock that's outperformed another, so they've got to sell some of that and buy some that has underperformed to keep the integrity of that target allocation. So you've got the fund manager rebalancing, and then you might have a model manager, a money manager that you're working with to have a certain model in your portfolio. Maybe you have a Vanguard target date 2040 fund. And within that model, there are 5 or 6 different exchange-traded funds. And now that model manager has to, again, rebalance to make sure that there's the right amount of weight in each one of those funds. So there's another level of rebalancing. And then you might get somebody like me that in your portfolio, I'm utilizing 4, 5, 6 different models. And so now I am rebalancing each model to make sure that there's the right amount of weight in each one of those models. So now you just had 3 levels, one on the fund level, one on the model level, and now one on the strategy level. Mm-hmm. So really important to get that right. There's a lot to consider when you're rebalancing because rebalancing can create taxes. It can interrupt rate of return. We've got to get back to that risk profile to ensure that in a circumstance of a downturn in the markets that you are taking the right exposure there. And so management of each one of those considerations is really important.
Well, let me ask you this, Sean. If we're talking about somebody who's within, let's say, 5 to 10 years of retirement, how quickly can this get out of hand if it's something that's ignored, if it's something that's not, talked about and addressed heading into retirement?
Oh, it can get out of control and very quickly. You might watch this out of balance happen over the course of 6 months to a year. If you've got technology in your portfolio, in your account, technology is crazy right now, and it's really, there's growth stocks that are outperforming by 10, 15, 20% sometimes another growth stock so quickly. And so this is why I really want to encourage you all to come in and have a discussion with us in the office. We're going to walk through, and I really want to encourage you to come into the office. If you're wondering about whether or not you're invested properly, if you're wondering about allocations in your portfolio, let's take a look at that. And Casey, I think this time for our first 5 callers, we're going to go ahead and include our portfolio X-ray.
Okay.
This is where we can dive deep into the holdings. We can get an understanding about what type of risk is in there, what the rate of return projections are. We can take a look at this rebalancing concept that we've been talking about today so that you get an understanding how that looks and how that works within your own portfolio.
You're going to want to take advantage of this deal. 559-847-0039 is that phone number to do it. If you're sitting here thinking, I honestly have no idea if my portfolio is properly aligned for retirement, that is a perfect reason to start the conversation with Sean. So give us a call right now, 559-847-0039. That's how you'll get connected. Or, of course, you can also visit us online at masonstreetretirementinsights.com and click contact. So we're talking about rebalancing, Sean, and why ignoring it can create problems as you get closer and closer to retirement. And that actually leads me to something else that I want to talk with you about today, because even when people think they're being careful, new risks can find their way into retirement plans without much warning. And we're starting to hear more about 401k plans potentially adding things like Bitcoin, private equity, even access to IPOs. regulators and plan providers are actively exploring these options, but they come with higher risk, they come with higher fees, and less transparency than what most people are used to in your typical 401k. So, Sean, I'm curious your thoughts on this, especially for somebody in their 60s who's nearing or maybe even already in retirement. How should they be thinking about these newer investment choices? What do you think? What are your thoughts?
Yeah, and we look at these as kind of the alternative asset classes or alternative investments. You know, the investment world, it's like technology. It's constantly evolving. It's constantly improving. And a lot of it's good. A lot of it's really good. And then some of it's not so good. So some of these new investment techniques, they really have a position in a portfolio to do some good things. But a lot of it could be smoke and mirrors. So it's really important to understand what's going on in there. There's a lot of these different strategies that are just destined to fail just because the inherent characteristics. Mm-hmm. You know, with any investment, you've got to make sure that you understand it. If you are choosing your own investment allocations, you got to understand fundamentals and understand what's really going on in those alternatives. And when I talk about understanding, you know, there's certain levels of understanding. Those of us that invest in Microsoft, we don't necessarily go in and look at the financials of Microsoft and understand every intricacy in that company. But there's a lot of credibility behind that company. There's a lot of discussion. There's a lot of information available. And so we rely on that information. If we were comparing investing in Microsoft to a startup company, you don't have that credibility. You don't have that history. And so you really want to dive in and understand what's going on inside of that company before you invest in it. And the same thing is going on with these alternative investments. What makes it difficult is sometimes there's just not a lot of transparency. Often there's very little history. So you really got to go get in and apply fundamentals. You got to stay out of the hype and the headlines and make sure that you understand what you're investing in. You know, keep in mind that we've always got to know what the purpose of the investment is. We've got to understand what we're trying to accomplish. Mm-hmm. And every investment is going to have a trade-off, and we've got to know what those trade-offs are and make sure that it's worth it. Can we still reach the goal and what we're trying to accomplish, even with the trade-offs that are inherent within that investment? Make sure that it fits within your plan, and that's why we're always preaching. You know, that planning element is so important so that we understand what we're trying to use a particular investment for. Mm-hmm. And especially with these alternative investments, there's a lot of considerations. You know, you got to consider risk. Often they're highly inflated with fees. Be very careful with liquidity, because very often there's a lack of liquidity, meaning you're committing to several years within that investment. Mm-hmm. You also got to know regulation. How is a certain one of these funds or investment strategies regulated? And then how are taxes going to be affected? How is your tax liability going to be affected by utilizing one of these strategies? You know, being intentional about the positioning is really important. Think of it like maybe you're building a house and you've got to have that core foundational structure. And in that portfolio, it's the same. You've got to have those core traditional strategies, but maybe you can utilize some design features to enhance the house, and the same with the portfolio, enhance the portfolio with the alternatives, but you still got your strong foundation.
I want to ask you this, Sean, because I feel like some people will hear about these new kinds of options inside their 401k, and they just assume, you know, well, it must be safe because it's allowed. But don't you think that's a dangerous assumption?
Yes. It's a really good point that you bring up, because you never want to rely on regulation.
Yeah.
Regulation is not going to be there to back you up if things go south. That is for sure. We've seen this time and time again. It ends up in court litigation. Attorneys are who make all the money, and the investors typically are the ones that miss out.
If you had somebody new come and see you, they're in their 60s, and they don't have decades to recover from a mistake. They're retiring in the next 5-ish years. What's your biggest concern that you'd have if you saw things like crypto or private investments showing up in their retirement accounts if they're that close on the brink of retirement?
Yeah, I got to make sure that that investor or that family that I'm talking to understands why they're there, understands why those holdings are in the portfolio in the first place. Maybe they didn't even realize it was in the portfolio. Maybe they didn't understand the consequences of what could happen. And so just a clear understanding of why they're using those particular investments, what they're trying to accomplish, and did they know the consequences if things don't work out well for them.
Well, so timing does really matter here, because if you've got someone at 35 talking about this in their 401k and someone at 65, they really should not be thinking or taking risk in the same way, right? Timing is a huge factor when it comes to this.
Yeah, it really is. And even though somebody is close to retirement, we can still recognize that there's a portion of the portfolio that is probably not going to be spent or used for, 10, 15, 20 years. So there might be a position for some of these riskier asset classes that they may need to have a little bit more time, like a 35 or 40-year-old would have. And so that's okay. It's just about proper positioning and ensuring that they understand the consequences.
Do you think sometimes people are chasing these types of investments because they've got FOMO, they've got that fear of missing out, even when the missing out might actually be the better, safer move for them?
Yeah, the hype gets to people. You said it. It's the FOMO, the fear of missing out.
Yeah.
But, once you really dive in and help them understand what those consequences are, what could happen, it seems like that the FOMO seems to subside a little bit.
Yeah.
And that hype dwindles.
And so I'm guessing, though, that you've then seen cases where people took on more complexity than they needed. Maybe it was because they feared missing out when simplicity would have actually served them better. And how do you talk them through that? How do those conversations go when you spot something that's not in their best interest?
Always understanding the perspective of when the money is going to get used. It's all about the timing of when the money in the portfolio is going to get used. It's the time horizon of each dollar that's most important. So then when you're looking at different types of investments for each dollar and you're considering what those horizons are, very often they're going to start recognizing what is right for them. It's just they needed the information. They needed the understanding of how those different types of investments perform, what the consistency is, how long they should expect to keep an asset class like that.
So is this something that you talk about with people in that introductory retirement planning assessment? I know today you're also offering the Portfolio X-ray on top of that. So is this something that you can take a look at for them if they give us a call and get set up today? Is this something that you guys can dive into in that conversation?
Yeah, I for sure. I want them to understand everything about what they're invested in. So important. I can't suggest that anybody invest into any type of a fund investment strategy without me completely understanding it. And I believe that when people understand the intricacies of each investment, they're going to know what they want for themselves. It's not about me having to tell somebody what they should be invested in. It's about me having to explain what the options are, maybe with some recommendations on the direction that they should go, but they're going to know what they want once they get the information.
If you'd like to get set up for your very own introductory retirement planning assessment and portfolio x-ray with Sean, 559-847-0039 is the number to dial. If you're sitting here hearing about these options inside your 401k and you're wondering, does this make sense for me? That is a great reason to give us a call and sit down and talk it through with a professional. 559-847-0039. When you dial that number, that'll connect you with one of our Mason Street teammates who will then help you get scheduled for that next convenient time on the calendar to talk directly with Sean. I promise you do not want to miss out on this opportunity, but our space is limited. So we want you to go ahead, dial right now, 559-847-0039, or head online to Mason Street Retirement Insights.com and click on that contact tab. Now, before we go today, Sean, it is Mother's Day weekend. So I heard this clip from Jeff Foxworthy this week, and I knew I wanted to play it on our show today. Jeff Foxworthy did not grow up dreaming of being a comedian. He actually was just kind of the funny guy at work, and his friends really pushed him to enter into this local stand-up contest. This was back in the 1980s, but I've got a clip from him I want us to listen to.
I was scared to death, had no idea what I was doing, but I knew a minute and a half into it, I'm like, this is what I was born to do. And I quit my job, and my mother's first question was, are you on the dope? I don't know what the dope is. And I'm like, no, I'm not on the dope. I said, Mom, I think I can do this. But 5 years later, I'm on Johnny Carson. That same mother said to me, you wasted all those years at IBM.
It's so funny. But kind of the moral of the story, Sean, is that families don't fear the dream. His mom didn't fear his dream. She just kind of feared the unknown. So I'm curious, when you've got a client's family and they're skeptical about how their loved one's retirement is going to go if they're ready, how do you walk the whole family through this so that it does not feel like a leap of faith? How do those conversations go when it's more than just the retiree sitting in front of you? It's the whole family.
Yeah, it's a really good question. It's an interesting dynamic, but, Jeff Foxworthy has been so much fun over the years. He did a tour with, back in the day, Larry the Cable Guy.
No, of
Remember
course.
Get Her Done?
Oh, yeah.
Yep, and Ron White with the Scotch and cigar routine. Those were good days. And, it was kind of fun with those guys because you could actually have the whole family listen to it. It didn't get too X-rated, and they still found a way to be
Clean comedy.
hilarious.
It still made you laugh.
Yeah,
That's a special
pretty
skill.
rare.
Yeah, I agree.
Isn't it?
I agree.
There's definitely a skill set there. But you're right, the family dynamic, it's so interesting, and at the same time, it's so important. I really try and help people when they come into the office and we're having the discussion that every decision that they're making is not only affecting them, but it's affecting their family, and not always have they thought about that. It can affect quality of life of them, but also their family members, whether it's their parents or whether it's their kids. And I find that the older that the couple is, the younger couples, typically the kids aren't as involved. But usually it's the spouse that we really have to focus in on, because often one of them has been kind of saddled with taking care of all the finances, and the other one doesn't always have a clear understanding of what's going on. They just kind of
taken a back seat all through the years.
They have, and they've just kind of trusted, right?
Yeah, it's dangerous, though.
And so it's really important that they get a clear understanding of what's going on. I've got to actually hear from them. I've got to understand what they're concerned about, what's important to them, what they would like to accomplish. It's not just about investing. And so getting that kind of clarity from the spouse is so important, and then them becoming aware that, look, if something happens to your spouse, you're going to have to step in.
Right.
So the more you know now, the better off that you're going to be.
Yeah.
And then as the couple gets older, I find that, and their kids actually get older, I find that they kind of start trying to step in a little bit, kind of start wanting to get a better vision of what's going on. They recognize that maybe they're going to have to step in and help, either if it's just physically or hopefully not, but they might be concerned that they'd have to step in and help financially.
Yeah.
And so I'm always making sure that the families that we work for understand that we're working for the family. It's not just the parents. And I always encourage them to bring their kids in.
Yeah.
And I have to be careful about privacy, of course, but I want to make sure that their kids are invited. In fact, we go so far as letting them know that we will create planning for the kids as well. The reason for that I find that the better off their kids are, the better lifestyle they're going to have, the parents are going to have. But also, when you take the kids through a planning process, they understand now better what's going on with their parents. And so it's a really good experience for them.
I think it's so important for the kids to be involved. We lost my dad really suddenly, and he was the money man. And, my mom was in the know. She's very, very smart, very educated, but he really kind of steered the ship. And so you better believe I've been in every single meeting with her when she's, trying to get a grasp and take over and figure out what she has to do. I've been right there beside her because, too, we need to know what's going on. Should something, God forbid, happen to her, we need to know what's going on. So I think it's so important to be part. And then on the inverse, we lost my husband's dad and there were no conversations. And we're in a real mess there where we could have totally benefited from sitting down, having these conversations. So kind of seeing both sides. And I'm like, we have the opportunity to be prepared and plan and take the right road on this side. We need to be involved as much as we possibly can. But a lot of parents do. It's the privacy thing that you were talking about. A lot of parents get kind of weird bringing in the kids, but I think it's so important. You got to kind of drop that sheet and allow the transparency to come through when you're getting close to retirement and these conversations start happening.
Yeah, I think you're right. And hey, how great is that for your mom to have you?
She's so
you've
lucky.
Got a lot of know-how, right?
I was like, hey, what time's the appointment? I'll be there. I'll be there early with bells on. But it honestly made her a lot more comfortable, I think, to have me there and my brother involved as well, because it's a lot to take on. It's a lot for her to get a hold of and get a grasp on. And you're sitting across from perfect strangers who, you're talking about your life savings with. And it can be daunting and it can be intimidating. So I think for a lot of people, having the family there can kind of ease the intimidation factor as well. So it's been great.
Yeah, that's really good. And I get it. And I see that as well. You're right. In the beginning, it's the privacy factor. But as we get going and we start talking about things, I don't have to get too in detail about everything. Mm-hmm. I just have to give the kids a fundamental understanding of what's going on. And they want to know that everything's going to be okay. And so, with that, Casey, I really want to encourage our listeners. I want to encourage you all to come in and have a discussion and, bring the family, bring the kids. We're so happy to have everybody come in and participate in that discussion. We'll walk through your situation. If you want the kids there, they have the opportunity to ask questions. And we're actually going to provide you with your own individual comprehensive financial planning assessment. We're going to take into consideration and discuss taxes, rates of return, risk factors in your portfolio. We're going to include that portfolio x-ray on this one. So give our team a call, and they're standing by. They're standing by right now, and they're going to find a good time for you to come in.
They are ready to take your call. 559-847-0039. I think this conversation is a great reminder that retirement should not feel like a leap of faith. It should feel thoughtful. It should feel intentional, and it should be shared by the people who matter the most to you. So if your family has questions about your retirement, let Sean help you turn the unknown into a plan that you can feel good about, that you can feel confident about. 559-847-0039 is how you reach us to claim your spot for your very own complimentary introductory retirement planning assessment and portfolio x-ray. I promise you don't want to miss out on this opportunity, but Sean's space is limited, so the time to call is right now. 559-847-0039, or you can always find us online as well. We are at Mason Street, retirementinsights.com. You'll click on that Contact Us button at the top, fill out your information, make sure you say you heard us here on the radio, and then we'll have a Mason Street teammate reach out directly to you. But the quickest, easiest way is just to call right now, and we'll get you scheduled. 559-847-0039. We'll give you a few minutes now to make that call while we take a quick break, but don't go anywhere. Lots more is still ahead here on Mason Street Retirement Insights. We'll be right back.
Hi, what'll it be?
I'll have a cone.
One vanilla cone coming right up.
Do you have any other flavors?
Unless you want vanilla.
When choosing an advisor to build your retirement plan, you want more than just one option.
That's all you have? Vanilla?
Unfortunately, that's how most 401ks are designed. Limited options. The vanilla ice cream of the financial world. Sean Mason of Mason Street Wealth Management can take that financial vanilla cone and turn it into your retirement banana split. Call 559-847-0039. That's 559-847-0039 or online at masonstreetwealthmanagement.com. The choice is yours. A world of options and retirement flavors, or...
Fine, you want something different?
Yes.
Okay, 2 scoops of vanilla.
There are many lessons we learn as we're growing up. One was, don't touch the hot stove. Ow. Today, Uncle Sam is trying to keep that lesson alive with your 401k. Think about it. Don't touch your 401k before 59 and a half. You'll pay a penalty. Hot stove. Oof. Or don't touch your 401k. You'll have to pay taxes. You'll get burned. Ouch. You've been saving in this account your whole life. Why shouldn't you use it for retirement? So the financial industry can keep charging you fees or the government can roll up your tax bill? Come on. Sean Mason at Mason Street Wealth Management believes in letting you enjoy your money. You worked for it, you saved it. Let's give you the confidence and permission to spend it. And there are plenty of options for you to explore. Go to masonstreetwealthmanagement.com to find out more. It's a no-obligation meeting to talk about planning and enjoying your retirement. Or call 559-847-0039. That's 559-847-0039. And let's give you some financial oven mitts for your 401k.
Welcome to Willie's Wings, home of the secret sauce.
I'll take a dozen wings. Oh, by the way, I love that sauce. What's in it?
Can't tell you.
Why not?
It's a secret.
While many financial advisors claim to have the secret sauce, they don't. In fact, if their sauce is so good, why are they keeping it a secret? Sean Mason of Mason Street Wealth Management doesn't keep anything a secret. He knows there's much more to retirement planning than stocks, bonds, and mutual funds. He'll develop a strategy designed specifically for you. It's your own secret sauce for retirement. Call Sean Mason at Mason Street Wealth Management for your personal portfolio x-ray. Call 559-847-0039. That's 559-847-0039. Or online at masonstreetwealthmanagement.com.
Fine, you want to know what's in the sauce?
Absolutely.
Tablespoon of paprika.
Really?
You have found Mason Street Retirement Insights. My name is Casey, and I am here with my buddy Sean Mason, president of Mason Street Wealth Management right here in Fresno, asking for his ideas on things that you can be working on as you get closer to your retirement. As you are listening today and you've got questions, want to remind you of our phone number. That's 559-847-0039. You can schedule some time to sit down with Sean for that introductory retirement planning assessment. 559-847-0039. Or we are also online. That website's masonstreetretirementinsights.com. All right, Sean, let's dive in today because there's been a lot of talk lately about ways that people could potentially keep more of their money in retirement. And one idea making the rounds definitely caught my attention, and I wanted to get your thoughts on it. One senator out of New Jersey, Cory Booker, he has floated a proposal to make the first $75,000 of income tax-free. Now, that could mean a lot in retirement. So I'm wondering, Sean, if you see many clients with income above $75,000, and if this ever becomes a law, would this actually help? Talk to us about your thoughts.
Yeah, it would certainly help those making under $100,000, but sounds like a soundbite to me. You know, it's easy to propose tax cuts. It's hard to find the money to replace it. And you know, Cory Booker's camp would take it from everyone making over $100,000. And since 5 times more political donations come from people making over $100,000, I doubt it'll ever see the light of day. But Casey, to your question, for sure it would make a difference. You know, every dollar we save in taxes increases lifestyle or at least generational wealth.
So even if this idea never becomes a law, what you're really saying is that tax savings still matter, especially in retirement, right?
Yeah, they do. And most families that I work with spend over $75,000 a year. In fact, most spend over $100,000 a year. But for a married couple filing joint, that first $32,000, more in some cases, is actually tax-free already because of the standard deduction. And for singles, it's the first $16,000. Then the next $100,000 falls into the 10 and 12% tax brackets. And then for singles, it's that first, it's that next $50,000. So the goal really is to control tax brackets. And when we're in retirement, if we position our savings strategically, we can gain a lot of control over those brackets.
Okay, so walk us through what that actually looks like, because it sounds great in theory, but what does it really mean in real life?
Well, you know, the big jump in the tax code, at least the federal tax code, goes from 12 to 22%. And if you can situate your savings so that you can stay under the 22% tax bracket for most of your retirement years, it can significantly reduce the amount of tax you pay over a lifetime, and in many cases into your kids' lives. This happens through tax diversification strategy. Imagine if you have some of your money in a pre-tax position, like your 401k or your IRA, and some in a taxable position, like the bank or a brokerage account, and then some in a tax-free Roth or life insurance contract. That gives you the ability to pull the right amount out of each account through the years. We see six-figure, often multiple six-figure tax savings using these strategies.
Well, and that's where this becomes real money for people, right? Because that's not small change that you're talking about here.
Well, that's for sure. And where the big surprise comes for many people is the tax consequence caused by required minimum distributions, or RMDs. We lose control of tax brackets because we're forced to take withdrawals from the pre-tax accounts, the 401k or the IRA, whether we want to or not. RMDs can cause more tax on Social Security, capital gains. They can increase Medicare premiums. And when our spouse passes, our taxes can double because now we have to file single. And those pensions usually suffer even higher consequences. The good news is, in many cases, we can mitigate this through comprehensive tax planning. And this is an area that most CPAs don't venture into. And if your current advisor hasn't initiated tax planning, it's probably not something they want to do.
So, Sean, how early should people be thinking about tax planning like this? Is this just a retirement issue, or do we need to start looking at this earlier than retirement?
We need to get to it right away. I would suggest 5 to 10 years from retirement is when you want to start positioning retirement savings for tax purposes. If you're already in retirement, then right now is the time to get started. And if it's not your area of expertise, I urge you to get counsel on your individual situation. It can mean hundreds of thousands of dollars. I invite you to call our office. We'll find a good time for you to come in or meet by Zoom. And it's a great opportunity for you to talk through your situation. We might have some recommendations you can use on your own, and we can determine if there's something we can do to help put you in a better position. So call right now. Our team is standing by, 559-847-0039. And for our first 5 callers, we're going to provide you with your own individual comprehensive planning assessment, estate planning, these tax strategies we've been discussing, investment allocations, all the elements you need to be thinking about to make your retirement lifestyle the best it can be.
559-847-0039. If you were thinking, I'd love a second set of eyes on this, I'd love to get this conversation started, now is a great time to call, and we can get that set up for you right away. If you've got $500,000 or more saved for retirement, all you need to do is dial 559-847-0039, or you can visit us at MasonStreetRetirementInsights.com, and we can get you scheduled for your very own complimentary introductory retirement planning assessment. Now, Sean, while taxes get a lot of attention, there's another assumption that a lot of people make about retirement, and that is how much they will actually spend over time. Does spending decline over the course of a retirement? Well, with all this inflation that we're seeing right now, you'd probably say no way, right? But I want us to listen to what financial advisor Dana Onspach recently told FinStream TV.
Right now, where everybody's talking about the price increases of gas and groceries, we are routinely saying, we have built-in inflation raises for you. Would you like to increase the monthly paycheck that you receive? There's room to do so. And even though we test and we model and we show them that they could increase it and it's not going to increase the risk of running out of money, overwhelmingly, we are still hearing people say, no, I'm comfortable on what I'm receiving. So they're absorbing those costs or making trade-offs, but nobody is expressing that they're feeling that pinch.
So I'm wondering, Sean, if you've noticed this, even when clients say, they're comfortable, how do you stress test that comfort level, and what triggers kind of make you say, hey, let's sit back and recheck the paycheck here?
Yeah, it's a good question, Casey, because this is a really important concept. you bring up, because it talks directly to lifestyle, which is actually my cause for the families I work for. It's income that drives that lifestyle, more specifically spendable or net income.
So it's not just what somebody has, it's what their income actually supports. That's what people really will feel month to month throughout their retirement.
Yeah, that's right. And there's a lot of strategy that goes into designing an income plan that'll last a lifetime. Rates of return, taxes, inflation will all affect spendable income. And spendable, you're going to hear me keep repeating that, spendable income is where it's at. But you brought up a really good point. It's part of the discussions I'm having with my clients, how expensive everything has become, inflation, and planning for that inflation in the future. And Casey, we should put that into context for people. The average inflation rate over the 30 years before the Biden administration was 2.3%. The average during that administration was over 5% or over double. And that's what people are feeling today. Its prices don't come down. That would be called deflation, which is just as detrimental to the economy. The economy is really at its best when the inflation rate is between 2 to 3%. Last year, it was 2.6. So we got back to normal. We will see inflation rise this year because of elevated oil prices due to the Iran conflict. But, analysts predict that will be very short term as long as the conflict is not prolonged.
So when you're building these spending plans for your clients, what assumptions are you actually using?
Oh, we're using rates of return, inflation rates. The point is that based on history, we can actually assume inflation will average 2 to 3%. And you originally asked about the paycheck conversations and how we stress test inflation over time. I find that most people want a very conservative outlook. So we use 1.5% COLA or cost of living adjustments on Social Security and pensions, and then we use 4% on inflation. And when we originally designed the plan, we overestimate expenses. Depending on what phase of life they're in, the go-go years when people are most active and traveling, the slow-go years or the no-go years, spending will change significantly.
And that's where the real-life decisions kind of start to change. That's where expectations meet reality.
Yeah, that's for sure. And, we have that paycheck discussion at least once per year. It really depends on their plans for that year. Sometimes they don't need an increase, but they decide to take an extra trip. In fact, I was meeting with Bill and Deborah. They were in the office last week, and we were talking about this year's spending needs. They didn't need an increase to their monthly withdrawals, but they have a trip to Costa Rica planned in the fall, and their granddaughter found out about it and asked if she could go. She's 10 years old. I got to tell you, it was so neat to see. Bill was smiling ear to ear when Deborah was telling me this. It made him feel so good that she wanted to go with him. So they asked me to model into their plan the cost of taking both of their kids and their families, spouses, grandkids, the whole family, an additional 9 people and $16,000. So we created a scenario with their plan to include the extra expenses. And we found that because they hadn't needed an increase in their withdrawals for last year, and then, like I said, they didn't need one this year, the inflation we originally factored in for the 2 years would more than pay for it. It was so neat. Deborah sent me a picture of the granddaughter cheering. It was so cute.
Cheering that she got to go on the trip?
Yeah, she was loving it. And, it's so great because instead of just taking the daughter, they're taking the entire family.
Wow, that's beautiful. I mean, that's really what retirement planning is all about, being able to say yes to moments like that and create those memories. That's what we work our whole life for, right?
Oh, it's so great. It's one of my favorite things of what I do.
So let me ask you this. What is a sign that somebody might be underestimating what they'll want to spend later on? Even if they feel comfortable now, what do you look for that tells you, hey, we might need to bump this up in the future?
When they start not spending, I'm a huge advocate of living life making sure that it makes sense, making sure that mathematically it makes sense. But I just want them to spend the money based on the plan. And when they start pulling back and they stop spending the money that we originally planned for, that's when I have to start talking about or getting real with what their opportunities are. On the flip side, though, if they start spending more money than we had planned on, that's when we have to sit down and have those more difficult discussions.
Yeah. So you mentioned that you revisit this spending conversation or the paycheck conversation annually. So I'm wondering why that annual paycheck conversation is so important. Even when nothing, seems to change from last year, why is it so important that you still revisit it every year and talk it through with your clients?
Gosh, it's such a great question. And you're right, we do have a plan. But that plan is not going to stay set every year. They found a great deal on a cruise and they're taking it and it's going to be an extra $10,000. Or, like Bill and Deborah, they decided they wanted to take their family. Things change. Things come up in the spending. And it's really important because the investment plan is dependent on the spending plan. And that's the key because we cannot get caught taking money out of an account that's gone down. So whatever dollar amount that we're going to spend this year, we've got to make sure those dollars in our position that they don't fluctuate in value.
These are conversations that are so necessary to have. And that number for you to start yours is 559-847-0039. If you're listening to this conversation and you're thinking, I feel okay, but I'm not 100% sure. I don't feel that confident in the plan I have behind me. That's exactly why Sean is offering you his complimentary introductory retirement planning assessment if you've got $500,000 or more saved for your retirement. 559-847-0039. That's what you need to dial. Remember, we have a limited number of openings this week exclusively for our radio listeners. This is your chance. You can sit down with a local professional. You can look at how your income and your spending actually work together and then see if any adjustments could help you feel more confident as you move forward into your retirement. 559-847-0039. We've got our teammates standing by right now. They're ready to take your call and help get you scheduled. Or you can always head online to MasonStreetRetirementInsights.com and you'll just click that contact tab and then we'll reach out directly to you. All right, Sean, we talked a lot today about taxes, about spending, but there's one more situation that I think can really test a person's plan. And it's something a lot of families don't expect or prepare for because sometimes retirement decisions, they don't come from a paycheck or a market move. They come from a sudden windfall. So I want to get your thoughts on a scenario that I saw this week. We have twin siblings, Ellen and her brother Arthur. They're in their early 50s, and they recently both inherited $500,000 from their aunt. So $500,000 each for Ellen and Arthur. So I want to talk about what each of them did with this money. Ellen paid off her mortgage for $280,000. She then did some home renovations. She took an expensive cruise and then did a lot of gifting. And then 3 years later, all that money was gone, but she does have a lot of equity in her home. Now, Arthur, on the other hand, he took a different approach. He paid off his credit cards and some other high interest debt. Then he increased contributions to his retirement accounts. And then he used the rest to kind of fill in the gaps. And years later, he still has a lot of that principal left. So, Sean, I'm wondering if you could talk to us about your thoughts on these two approaches to this windfall. And does this kind of line up with what you typically see when clients inherit money?
Yeah, and this isn't rare, actually. In fact, there's two concepts here that come up often in conversations I have with families when they first come into my office. The best use of inheritance and then whether or not to pay off the home. And both, of course, are going to depend on the current situation. But when we're working with a family or individual in designing their retirement plan, and they know there's a probable inheritance, they usually are reluctant to put it into the plan.
Okay.
First, they're being pragmatic in that you never know what healthcare costs can end up being. But also, probably the emotion side, they don't want to base their lifestyle on being given something.
Well, and that kind of discipline that you're talking about probably saves a lot of regret later on, but I feel like that's a very different mindset than most people have. I feel like that's the exception, not the rule.
Yeah, I'll tell you what, it goes all different ways, but it's pretty often that, they feel that way. And so we actually end up creating an additional scenario in their plan to account for the best use of the inheritance. And that ends up being a much better situation than when they get that surprise phone call letting them know that Aunt Mary died and left them money. Yeah, that's what we call newfound money. We didn't plan on it, so let's buy the new car or take another trip. I will say the families we guide through retirement planning are very good at getting with us to talk it through. But Casey, all money in retirement, it's a balance between safety and lifestyle, and each individual's priorities are different.
Okay. Well, so I want to talk about this mortgage decision that Ellen made, because that's, I feel like, where a lot of emotions really come into play for people. So talk to us about your thoughts on paying off the mortgage.
Yeah, well, when it comes to paying off your mortgage in retirement, there isn't a one-size-fits-all answer. It really comes down to trade-offs. You know, on one hand, paying off the mortgage gives a feeling of certainty and safety. And not paying interest is the same as earning interest, and it's guaranteed. You know, it also creates a better cash flow by lowering expenses. But then on the other hand, when you tie up money in your house, there's opportunity costs. Historically, a diversified portfolio has earned more than the interest rate of a mortgage. So mathematically, you could be better off keeping the mortgage and investing that money. And it's important to keep in mind, if you have a $200,000 mortgage and you also have $200,000 in an account that you could use to pay off the mortgage, your mortgage is essentially paid off. It's just in a separate bucket. You should also consider flexibility, because equity in the house is not as liquid as money in an account. You know, often people don't realize that when retired, if there's not a sizable pension, it might be difficult to qualify for a home equity line of credit because of low income. They don't look at assets as a means to make the payment. So it comes down to, does the feeling of having your home free and clear outweigh a probable financial benefit of interest rate arbitrage and flexibility?
I'm curious, in the history of your career, what's the biggest mistake you've seen somebody make with an inheritance?
Yeah, it's real, and there's always such regret when it happens. But it's always that situation to where they weren't planning on it, they didn't realize it was even there, and all of a sudden they get that phone call and they get emotional. They feel like their retirement plan, they've already decided what their lifestyle is going to be, and then all of a sudden they get this influx of money and they go out and spend it, and there was no thought through it.
Yeah.
Most of the time, it's the families that we work with, they're going to come to us and we're going to talk it out. But I've had several situations where we weren't working with them yet, and they came to us after the fact.
Yeah.
And it reeks of regret, and it's really unfortunate to see.
Yeah. So you would say the biggest mistake is people being hasty when they get an influx of money. So kind of like Ellen, I feel like she was a little hasty with her decision. So had she slowed down and talked through a plan first with a financial advisor like yourself, what could have looked different for Ellen versus Arthur?
You know, in the planning, in that planning process, and even when you already have a plan, the way you're able to go out and test everything, she actually made some reasonable decisions.
Yeah.
You know, she paid off the mortgage. What's wrong with that? But before you pay off the mortgage, it's important to see how it works out mathematically in a plan, because there's two sides. One side is the pragmatic, the math side. The other side is the emotion, and they're both equally as important. But how do you really know how you feel if you don't know the math? So having that plan worked out, having that tested is really going to help you understand the math and look at all sides so that you can decide how you really feel about it. And so, you know, we're talking about these things all the time with the families that we work for, having these discussions with people come in for the first time. You know, I really encourage you to pick up the phone and give our team a call. Come in and have the discussion. It's a great opportunity to get some additional insight on your individual situation and you know how it's affecting you right now, and it's how it's going to affect you in the future. And is there any strategy that can be utilized to improve your position? You want to know that stuff. So give us a call and come in and we'll walk through it together.
That number to do it, it's 559-847-0039. I think this story of Ellen and Arthur really highlights something important, that it's not just about how much money you have, it's really about how purposeful you are with it. So if you're thinking, I want to make sure I am making the right calls, not just the easy ones, not just the ones that feel good in the moment, that's exactly where a conversation with Sean can help you out. 559-847-0039 is what you need to be dialing right now. Sean is offering you his introductory retirement planning assessment. Remember, this is exclusive just for our radio listeners with $500,000 or more saved for retirement. This is a chance for you to sit down with a local professional. Sean is right here in Fresno. He's going to take a look at your entire financial picture, and you guys can talk through the decisions that really are going to matter for your retirement. So give us a call right now, 559-847-0039, or head online to MasonStreetRetirementInsights.com. Click that contact tab, fill out your info, make sure you say you heard us on the radio, and then one of our Mason Street teammates will reach out directly to you. That is going to do it for us this week here on Mason Street Retirement Insights. But Sean and I will be back next week, same time, same place, with more retirement insight for Fresno. But until then, Sean, I'll hand it back over to you for the final word. Take us out, my friend.
That was a lot of fun, Casey. Love hanging out with our community. Want to encourage everyone to keep coming back. We care about your success. We want you to succeed, and we're going to continue to bring information that's going to help you do that. I want to shout out to all the mothers out there. Happy Mother's Day. I want to point out my mom. She's living her best life in heaven, but I know she's still listening. So happy Mother's Day, Mom. See you next week.
Mason Street Wealth Management, MSWM, is a registered investment advisor, and the opinions expressed by MSWM on this show are their own and do not reflect the opinions of Motivate Investments. Registration is not an endorsement by securities regulators. Investment advisory services are offered through Motivate Investments, an SEC-registered investment advisory firm. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. By contacting us, you may be provided with information about insurance products, including annuities, offered through Sean A. Mason, California, insurance license number 0B54860. The firms are separate entities. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company and are not offered by Motivate Investments. Read your contract for restrictions, limitations, or penalties. MSWM is not licensed in all 50 states. To find out if MSWM is licensed in your state, please call 559-892-0002.
Okay, single room with a queen-size bed, non-smoking, $139.50.
The ad said $99 a night.
That's before the fees.
Fees?
Yeah, the service fee, internet fee, parking fee, ice bucket fee. You might use the luggage cart.
Unexpected fees. We see them all the time. Cell phone bill, cable bill, your internet provider. Have you purchased a car lately? And your retirement accounts. Sean Mason at Mason Street Wealth Management can show you how to identify these fees and design a plan to reduce them. It's all a part of their Portfolio X-Ray with a deep dive into your 401k and other holdings.
Uh-oh, forgot the free breakfast fee. Oh, and the dome over the pool fee.
More of your money can go toward your retirement, not to some suit on Wall Street. Call the team at Mason Street Wealth Management today for your complimentary Portfolio X-Ray. 559-847-0039. That's 559-847-0039 or online at masonstreetwealthmanagement.com.
There was a time when the answer was
$1 million.
$1 million.
$1 million.
$1 million.
$1 million.
$1 million.
the question, how much is a lot of money? Think about this. During the 80s, there were about 500,000 millionaires in the U.S. Today, there are over 18.6 million. There are millions of millionaires. The point is this. If you've saved $1 million for retirement, congratulations. But even if you haven't, that's your fortune. whether you carry that label of middle-class millionaire or not. Sean Mason at Mason Street Wealth Management can show you how to take those hard-earned dollars and create years of retirement happiness. When you do the math on your retirement, it's more about the number you get per month than the amount you've saved. Call Sean Mason at Mason Street Wealth Management for your complimentary retirement review. 559-847-0039. That's 559-847-0039 or online at masonstreetwealthmanagement.com. Want to retire like a millionaire? Call Mason Street Wealth Management today.